All right, let's dive into the Value Investor's Playbook. Today, we're going to tackle one of their most powerful and, honestly, most misunderstood tools, the price-to-book ratio.
So, you ever look at the stock market and just wonder, how do the pros do it? How do they seem to find these incredible bargains that everyone else just walks right past? What is their secret for spotting those hidden gems?
Well, it's not some kind of magic trick. A huge piece of their strategy is just tuning out all the market hype and the day-to-day noise. They focus on what a company is actually worth, like right there on paper in its accounting records.
Okay, so here's our game plan for today. We'll start with the mission, finding a bargain. Then we'll get into our core tool, the PB ratio itself. After that, we'll open up the field guide to see what the numbers are telling us, and then, super important, we'll cover the known traps. Finally, we'll wrap it all up with the final briefing. Ready? Let's go.
First up, the mission. And it's a pretty exciting one, actually. It's the quest to buy a company for less than what it's truly worth.
See, the whole idea behind value investing is, well, it's simple, but it's also incredibly powerful. You can think of value investors as financial detectives. They're on the hunt for companies that the market has just plain misunderstood or overlooked. Their goal? It's to buy $1 worth of a company for, say, 50 cents.
And one of the main tools they use to find these bargains brings us right to our next section. We're going to decode the price-to-book ratio, or PB for short.
So what is this thing? The price-to-book ratio is really just a straightforward comparison. On one hand, you've got the company's market price. That's what you'd pay for it on the stock exchange. And on the other hand, you have its book value, which is what the company is technically worth according to its own books.
And the best part? The formula is super simple. It's just the market price per share divided by the book value per share. That is it. No crazy calculus required. So let's just quickly break down each of those pieces. First, we've got market price per share. Honestly, this is the easy part. It's the price you see on Google Finance, Yahoo Finance, wherever. The current cost to buy just one share of that company. It's what the market thinks it's worth right now.
Okay, now for book value per share. This is where it gets interesting. I want you to imagine a company decides to have a giant everything-must-go sale. It sells off everything it owns, the factories, the computers, the cash in the bank. Those are its assets. Then, it uses that money to pay off all of its debts, its loans, its bills. Those are its liabilities. The cash that's left over at the very end? That's the book value. And if you divide that by the number of shares, you get the book value per share. It's basically the company's net worth if it were to just liquidate everything today.
And this right here highlights the central tension. See, market value is all about feelings. It's about what investors hope will happen in the future. It gets pushed around by news and sentiment. But book value, that's the cold, hard reality based on the accounting books. It's a look backwards. And that gap, right there between perception and reality, that's where value investors go hunting.
Okay, so we have our tool. Now we need the field guide. How do we actually read the signs? What are these P/B numbers trying to tell us out in the real world?
For decades, this has been the magic number for value investors, a P/B ratio under 1. It's kind of like the Holy Grail. Why? Because a ratio below 1 means you might be paying less than $1 for $1 worth of the company's assets. It's the ultimate signal that something might be on sale.
So, as a general rule of thumb, a low PB, especially under 1, is like a big flashing sign that says, hey, look over here, this stock might be undervalued. On the other hand, a high PB, let's say over 3, usually means one of two things. Either the stock is just plain overvalued, or investors are expecting massive growth in the future and they're willing to pay a hefty premium for it.
But, and this is a really big but, context is absolutely king here. You cannot, I repeat, cannot compare apples and oranges with this ratio. A heavy manufacturing company full of factories and machinery might have a P/B of 0.9, and that could be totally normal. At the same time, a software company whose biggest assets are brilliant coders and lines of code might have a P/B of 8.0, and that could be normal too. The key is to always compare a company's P/B to its direct competitors in the exact same industry. Look, the PB ratio is a fantastic tool, but it is not a magic wand. It has its limits. So it's absolutely crucial that we talk about the known traps and understand when this tool might actually point you in the wrong direction. So the PB ratio has some pretty big blind spots. First, like we just touched on, it really struggles with modern tech and service companies. Their value isn't in buildings, it's in things you can't touch, like brand recognition or patents. I mean, think about it.
The brand value of a company like Coca-Cola is worth billions, but it doesn't really show up on the balance sheet. This is a huge reason why investors like Warren Buffett evolved from buying just cheap companies to buying truly fantastic businesses. Also, accounting can get tricky. Things like share buybacks can mess with the numbers, and different accounting rules around the world make it tough to compare companies globally. And probably the biggest blind spot of all, it's all based on historical data. It tells you where the company has been, not where it's going.
Now, even with all those limitations, it's worth just pausing on this idea for a second. At its heart, the P/B ratio is just comparing what you pay for a stock to what the company actually owns minus its debts. It's that simple, direct comparison that still makes it so incredibly useful.
Okay, that brings us to our final briefing. Let's pull everything we've learned together and talk about how to use the price-to-book ratio like a smart, thoughtful investor. So here it is, your 3-step playbook. Step 1 is to identify. Use a low P/B ratio as a starting point, like a radar screen, to find companies that might be interesting. Step 2, compare. Always check that ratio against its direct competitors. And step 3, investigate. You have to remember, a low P/B isn't the final answer. It's the question. It's your cue to start digging deeper with other tools to figure out if you've really found a hidden gem or just a dud.
If you remember just one thing today, make it this. The P/B ratio is not a magic 8-ball that flashes by. It's a powerful question starter. It forces you to ask, okay, why? Why is the market pricing this company so low? Answering that question, that's where the real investing work begins, and that's where the real rewards are.
So, we'll leave you with this final thought. The P/B ratio is a fantastic tool for getting a sense of what a company's worth right now. But the real art of investing, the real challenge, is figuring out what it could be worth tomorrow. So what tools are you going to use for that part of the mission? Thanks for digging into this with us.